Hey friends, I'm Gladys. Let's become better at investing together. So, today let's talk about JEPI. Is JEPI the best monthly dividend ETF? Is it the best among all the covered call ETFs? Does it provide better returns than just buying SPY? And are there any potential risks in investing in JEPI? So what is JEPI? JEPI stands for JP Morgan Equity Premium Income ETF. The fund's objective is to capture a majority of the S&P 500 index returns, but with a lower volatility. On top of that, it aims to give you monthly income. So here is how it does. It buys stocks in the S&P 500 index, and then it sells call options on the S&P 500 index for monthly income. So what's the difference between JEPI and the SPY? JEPI is an actively managed ETF, which means its fund managers will decide what stocks to buy and what stocks not to buy based on their analysis. So for JEPI, actually underweight mega cap names such as Microsoft, Meta, and Google, and it also underweight high growth sectors relative to the S&P 500 index. And the fund managers also don't want to buy any stocks that they consider too expensive or too volatile. In fact, they prefer smaller companies with reasonable valuations. On the other hand, SPY is a passively managed ETF. So that means the fund managers don't have to do anything except to closely track the S&P 500 index. And another difference between JEPI and SPY is that JEPI sells call options for monthly income. And in terms of expense ratio, JEPI has a higher expense ratio, which is 0.35% a year. On the other hand, SPY's expense ratio is only at 0.09% a year. Now let's look at JEPI's top 10 holdings versus SPY's top 10 holdings. As you can see that for SPY, Microsoft actually accounts for more than 7% of its entire portfolio, whereas for JEPI, Microsoft takes up less than 2% of its portfolio. So you can see that JEPI underweights all the mega cap names compared to the SPY. Now let's talk about the pros and cons of investing in JEPI. One of the advantages of investing in JEPI is that it has a lower beta than the S&P 500 index because it allocates more funds to defensive stocks. For example, JEPI actually outperformed the S&P 500 index during the sell-off in the last quarter of 2018 as well as the 2022 market meltdown. It achieved this because it collected income by selling call options on the S&P 500 index, and its portfolio is also more defensive than the S&P 500 index. Another advantage of investing in JEPI is that it gives out very high monthly dividends. In fact, its annual dividend yield ranged from 8% to 12% since inception. That's quite high when you compare to the dividend yield of the SPY. And as you can see from this table that JEPI has been giving out regular dividends every single month without fail. And this is a graph of JEPI's dividend yield. As you can see that for the past 12 months, the dividend yield has been fluctuating around 10%. And another advantages of investing in the JEPI is that it outperforms the S&P 500 index during a sideways to a slightly downtrending market. So if you think the market in the near term is going to move sideways or it will be going down, it might be a better idea to put money in the JEPI instead of the SPY. Because during a sideways to a slightly downtrending market, JEPI actually can achieve better returns by selling call options. Now let's look at the drawbacks of investing in JEPI. One of the disadvantages of investing in JEPI is that it underperforms the S&P 500 index during bull market. For example, during 2023, the S&P 500 returned 26.19%, while JEPI returned only 9.81%. And also JEPI trailed the S&P 500 index by 21.3 percentage points between March 23rd, 2020 and December 31st, 2020, when the market staged a strong rally. So as you can see that you really lose out a lot by investing in JEPI during a bull market. And the reason why JEPI underperformed the S&P 500 index during bull market is that the selling of call options significantly limits the upside of JEPI's equity portfolio. Okay, let me give you a hypothetical example to show you what I mean. If, let's say, if you bought a stock at $100, then you're willing to get paid $3 to sell the stock at $102 at the end of the month. If the stock goes up to $120 by the end of the month, you still have to sell the stock at $102. So you received a total of $5, the $3 premium plus the $2 upside at the end of the month. But you miss out a total profit of $20 if you hadn't sold any call options on the stock. So another downside of investing in JEPI is that when volatility drops, the dividend yield you're going to receive will also go down as well. For example, it was a strong bull market in 2023. Volatility has been steadily declining, and JEPI's annual yield also dropped from a high of 12% in 2022 to 8% in 2023. Now, another downside of investing in JEPI is that the fund actually sells call options through the use of equity-linked notes. Equity-linked notes are actually issued by counterparty. That means you face counterparty risk. If the counterparty defaults, you won't get paid. Another downside of using equity-linked notes is that equity-linked notes are taxed as interest income, not capital gain. Therefore, you will have unfavorable tax treatment. Now let's compare JEPI against other covered call ETFs. As you can see from this table, for the 1-year return versus S&P 500, JEPQ actually is the best performing covered call ETF. And if you extend the time horizon to 3-year return versus S&P 500, you can see that JEPI actually is one of the best performing covered call ETF. But if you look at 5-year return versus S&P 500 or the 10-year return versus S&P 500, you can see that all the covered call ETF significantly underperform the S&P 500 index. So over the long term, SPY total return still beats almost all the covered call ETF by a large margin. As for the JEPQ, JEPQ stands for JP Morgan Nasdaq Equity Premium Income ETF. This is the Nasdaq version of the JEPI. For the past 1 year, it has outperformed the S&P 500 index, but JEPQ has only been around for about 2 years, so it remains to be seen whether it can still outperform the S&P 500 index in the long run. If I'm a long-term investor, I'm going to go for SPY because, as you can see, for all the other covered call ETFs, over a long period of time, it has significantly underperformed the S&P 500 index. But if I'm looking for monthly dividend income, I think both JEPI and JEPQ are okay, but I will be mentally prepared for a lower dividend yield because the Fed is expected to cut interest rate in the future. When the interest rate goes down, the premiums that you get from selling call options is going to go down as well. If you are interested in more videos on dividend ETFs, check out my other videos.